This is the daily fiscal pulse for the 15th of June, 2026. A quick note before we start. You're looking at a look back here, not a live feed. All the data we're covering reflects what we saw through the end of Monday's trading session. To start, let's talk about what's capturing attention in the broader market. The dominant narrative right now is AI and tech. You're seeing headlines like SpaceX jumping 4% to overtake Amazon in market cap, still falling short of Microsoft, and that's clearly shaping how money is moving. Now let's look beyond the headlines and see what the actual flows are telling us. The numbers came in with net fiscal transfer hitting $87.5 billion for the day. That's a reasonable number on the surface, but what's more significant is the shift happening on the shorter time frame. The 5-day average has decelerated to roughly half of what we've been tracking recently. The primary driver here is tax receipts, which came in at $110.5 billion. Despite the fiscal backdrop, price action is holding its ground. The ES futures closed at 7,564, trading above the 20-day moving average of 7,495. The 20-day range spans roughly 385 points. We're seeing price stability even as fiscal headwinds are present. The real story is in the longer view. Government spending on a 5-day basis is averaging about $16.4 billion per day right now. When you stack that against the 20-day average of $4.2 billion, the slowdown becomes pretty clear. To put it plainly, there's less liquidity flowing into the system, less money cycling through households and reaching the markets. The result is tightening financial conditions. Year over year, the pattern only reinforces this. We're sitting at $1,022.7 billion in fiscal spending since the fiscal year began, which is roughly 6% below where we were at this point last year. That's a material pullback in fiscal support, and it has real implications for how much liquidity is available. If you're holding long positions, the fiscal environment deserves attention. We're not looking at a scenario where fiscal policy is tailoring markets here. Our conditions gauge is running at -61 right now. That said, history offers some perspective. We've been in similar situations before, and even with lighter liquidity, the S&P has averaged around plus 1.6% over the following month. Markets don't track liquidity in a straight line. They often grind higher in spite of softer conditions. There's also the leverage question. Margin debt is sitting in the 100th percentile, which signals elevated positioning. When we've seen levels like this historically, they've tended to function as a caution rather than a bullish signal. What does that mean in practical terms? Fiscal flows are running below last year's pace, which means the shock absorbers in the system aren't as thick. When the news flow supports risk-on moves, markets can still push higher. But when risk events occur, say a flare-up in AI or tech volatility, declines can accelerate because there's simply less buying power sitting underneath to step in. One more thing, we've now seen 3 straight days of declining fiscal transfers. That deterioration pattern usually shows up in price action within a short time frame. Keep an eye on the calendar. The 17th of June brings the SSA payment cycle, which falls on the third Wednesday of the month and can materially shift the flow picture in the near term. The bottom line is that fiscal drag is clearly present in the data, but there are signs the rate of tightening may be starting to level off. What happens next is likely going to depend on how these scheduled payment cycles land. That's where the edge lies right now.